Good morning, all of you.
Good morning, sir.
We are trying to start the session on integrated risk management. Last week, we discussed about individual loans and their calculation of probability of default, loss given default, and the exposure. How we can do that in an individual basis. Now we call that the transaction risk, credit transaction risk. Whatever the risk we supposed to, we have to just quantify it in terms of individual basis. Today we are going to discuss on portfolio level risk. For an organization, financial organization, a bank or whatever, they have to face with such exposures because they just stop their things with one or two loans. They grant a number of loans in one category. That homogeneity really demands them to put it in one lot. That is what we call a homogeneous portfolio. What do you mean by homogeneous? It is similar. All the loans are similar in some of the characters. When you talk in terms of probability of default, more or less, all the loans are in the same level of, or if you say average probability of default, it is more or less same. That we can convince. No, sometimes you might not accept it as it is, but what I can tell you is, if you can recognize a portfolio and do an analysis of rating, or in other words, if you do a rating review, so we will feel that a very high percentage of loans might get into a one rating category. So that means if it comes to a one rating category, that means its probability of default has a same value. So that is the particular thing which we need to understand with regard to a portfolio. When you talk in terms of a portfolio, there are several other things to be considered. Now, when we look at the portfolio, you all know the loans, or we call it asset in general form, they have a connection, they have a relationship, they have a correlation, we call it. That is a technical term we use for that, the correlation. Now, in economic terms, this correlation plays a major role because the correlation comes with the economic factors. You all know that in any bank, there are different gradings of customers according to the creditworthiness of them. There are some customers who are highly creditworthy. Then there are some other customers, they are not that creditworthy, but they are also reasonably creditworthy. And there's another level, a medium level. They are, we can say they are creditworthy, but there are issues. And there's another category, they are not at all creditworthy. So likewise, you can just get a general classification. Now this classification really goes to the, really has a dependence with the economic situation in the market. If the economic situation really goes down, so we can see what type of a correlation or what is the impact on the correlation through the economic factors. For a simple example, if you can imagine the times where the economic downturn was experienced in 2008-2009 period, that time most of the portfolios, even though originally they didn't have any correlation, but at the time of economic downturn, the correlations were really higher. And that correlations are positive correlations. Or in other words, that is basically a default correlation. Now, what do you mean by a default correlation? If one loan defaults, there's a tendency of other loans also being getting defaulted. So that is the correlation. And we call it default correlation. So that default correlation is very, very high in a economic downturn. So it's an economic factor. Right. Today we are trying to just get some ideas about portfolio risk, credit portfolio risk, and some types of quantifications with regard to the portfolio risk, and very important model called Vasisek model we are going to discuss. And I will just put you into a presentation, PowerPoint presentation, which so before going into that, I just ask you some type of clarification type of questions where you need to give your responses with regard to the things which we have done last week. There also we discussed on the Merton's model. Now these things are basically model, and we can say very modern type of credit risk models. I think the internationally active banks, they follow and they use these type of models in their credit risk management activities. Therefore, it is very much important for us to learn and have an idea about these models. And it has a scientific basis. That is why we need to have such models identified and get to know what are the applications. And we need to just get an idea about the assumptions and other background with regard to such model usage. Now, that's what I just want to get some of your responses with regard to that, because it's a rather new area. Because I think you might have followed some courses in credit risk management or credit or whatever, but you might have not come across such type of models. So therefore, even though you don't need any fundamental mathematics or statistics for this, you need to have some background idea. Right, anyway, if you have any issues, let me know now, then I can really yes.
Yeah, I need some clarification.
Yeah.
Using that Merton model, we calculated probability default for the 5-year period.
Yeah.
Last week.
Yeah.
Then if we need to calculate probability of default for the 1 year,
yeah,
then what are the changes that are applicable for the variable of risk-free rate of return, then volatility? Because we can't use the same volatility and same risk-free return for the 1 year period.
Yeah, correct.
Yes. Then sir, how we grab that information if we need to calculate probability of default for the 1 year period?
Yeah. No, if it's like this. Now, there are situations where you have to just do those things with certain assumptions. Now, if in a situation where you need to get the 1 year probability of default, then basically they might give the 1 year volatility. Now, even though we have that the volatility depends on the time period, there are some situations where you sometimes assume the average volatility is same for the particular period. So that is what how the things are coming on. But I think your concern has a valid point, and as the case may be, you have to take a decision. Now there are situations where you cannot use the 1 year volatility rate for 2 years. So such situations, either you need to have some other data points in order to calculate the average volatility for the 2 year period. So there can be a situation where you might get some data points in order to calculate that. If you don't get such data points, then you need to have a assumption and say that you assume that the volatility has no change even for 2 years. So that is how you can tackle such type of question. The other thing is, now when you really predict something for 5 years, there can be several shortcomings. There can be several types of deviations from what you have thought. So, but there are different other methods to see how we can see the margin of error. So that's another way. Or in other words, there's another thing called backtesting, where you can do it afterwards and check whether what you have thought was correct. So these are the methods available to really deal with such type of limitations. Right. If that answered your question.
Yes, sir. Then sir, another one that if we
Yeah.
need to calculate probability of default for a less than one period, that means less than
Less
1 year.
than 1 year, yeah, less than
Yeah,
1 year,
yeah.
yes.
Yes,
Yeah.
sir. Then do we need to incorporate that risk-free rate of return into that period? That means if we need to calculate for
Uh,
a 3 month period, then
of
risk-free
course,
rate.
yes, of course, yes.
Then can we use that 91 days treasury bill rate as a risk-free rate
Yes,
for a
yeah. But normally the risk-free rate, there's a definition for risk-free rate. Normally we take the risk-free rate as the 1 month notional treasury bill rate. That is the that is the normal definition for risk-free rate. I think there's a background in that. If you say 3 months or so, there's a small risk of market. Because of that, in order to minimize that, we have taken the risk-free rate as the 1 month notional treasury bill rate, because there are no 1 month treasury bills, no. So you can construct a yield curve of treasury bills, and you can just extrapolate the rate for 1 month, and that 1 month rate is normally considered as the risk-free rate. That is how it is been taken. But 1 month rate given in per annum terms. 1 month rate given as per annum rates. That is how you give it. So that is the risk-free rate. That is the definition of risk-free rate. Now, as you say, if you are going to calculate a particular period which is less than 1 year, then the probability of default calculations, you can use it as it is. So of course, say if you try to have a 90 days type of period, and it is a 1/4 of a year, yeah, 1/4 of a year. So likewise, you can put it that way. So that is what you need to do. You got my idea?
Yes, sir. Yes.
Right. Now today's things we will try to just start. Now before going into this text, I will go to the presentation. Now here we are trying to get an idea, quantitative idea with regard to the expected and unexpected losses. Now, in a portfolio, how are we going to get into the expected and unexpected losses of a portfolio level things? And we will just discuss on that. And before that, we are trying to get a quantification on the expected and unexpected losses of a individual trade. Now, our real idea is to go into a portfolio setting, whereas in order to get a portfolio set in configurations, we have to see the individual loans first. Now, it is like this. When you try to talk on expected losses, now say you have 100 loans in a portfolio. You have to calculate each expected loss of loan. There can be 100 expected losses in the portfolio, and the total of those 100 expected losses will come to the total portfolio expected loss. I think that is clear. Now, in terms of expected loss, the matters are not that difficult. Matters are simple. And when you try to calculate the expected loss, there what you do is you get the probability of default for 1 year. That is the life, not the lifetime, we call it current expected loss, so 1 year expected loss. There you have the probability of default, and then you need to have the exposure and the loss given default. When you multiply these three things, you get the expected loss of that particular individual credit. And assume that you have 100 such loans in a portfolio. You have to calculate the 100 expected losses in that portfolio, and the total of which will give you the total expected loss of the portfolio. So that is how the portfolio expected loss is calculated. Now, I think most people need to have that idea in order to get the CECL, current expected credit loss calculations, coming under SLFRS 9. So that is the indication here. So therefore, the theoretical background and the practical significance is also given here. So therefore, this is an important lesson for you. But in IFRS 9 current expected credit loss calculations, they talk only in terms of expected losses. So that is a simple case. But when in the risk management, our concern goes to more or less the unexpected loss. Because if we can provide capital to the unexpected loss also, then we can be comfortable, because we have the sense of safety. Because even for unexpected losses, if you provide capital, then you are your bankruptcy or whatever is very much protected. I mean, you won't go into bankruptcy because you have enough capital to face with even an unexpected loss situation. So therefore, in risk management, more concern is given to the calculation of unexpected loss. But in the case of a portfolio, when you take one loan and calculate its unexpected loss, and if you try to get the unexpected loss of the portfolio, you will see that the portfolio unexpected loss is significantly less than the sum of individual unexpected losses. So that is the basic thing we need to understand. Because the reason is, when you have a portfolio, the portfolio risk, the total portfolio risk would be lower because of the diversification effects. Now, through the diversification, we can get rid of idiosyncratic risk or individual type of risk, inherent type of risk can be get rid of by diversification, through diversification. That is the reason the unexpected loss of the portfolio is significantly less than the sum of individual unexpected losses. Now you can just compare it with the expected losses. In terms of expected losses, when I told you, you have to calculate the expected loss of an individual loan. And if you have 100 loans in the portfolio, you have to determine the expected loss of each and every loan, 100. Those 100 loans to be added together, then only you get the individual expected losses of the portfolio, total individual expected loss. Alternatively, when you do it for the unexpected losses, it is not the case. It may not be the total of individual unexpected losses coming as the portfolio unexpected loss. That figure is very much lower than the total losses. The reason is the diversification effect. Now, when you deal with unexpected losses, the correlation between the assets or the loans would be a very important factor. We will see what are the types of methodologies we can follow in order to calculate the unexpected losses. But if you look into the parameters of expected and unexpected loss, you might see that all these parameters, all these concepts, the factors depend on similar type of parameters. Now, when you say different type, the parameters, I think now we have an idea about these parameters. Basically, the probability of default, loss given default, exposure, and those are the parameters in the calculation of expected and unexpected losses. For expected loss, also the parameters are same. If you take the unexpected loss, there also you get the same parameters. But there's a difference in the way it really decides the expected and unexpected loss, because the parameters are having a certain combination in expected loss and certain combination in unexpected loss. Now you have to just look at one type of it. Expected loss increases linearly with the probability of default. What do you mean by that? When the probability of default goes up, expected loss also will go up. That is what it means. But UL, or the unexpected loss, is a non-linear function. It is not linear. You know, the linear means there will be a proportionate increase. But when you say non-linear, it is not a proportionate type of thing. Therefore, that function, now say, probability of default when it changes, when the probability of default changes by a very small fraction, there will be a very high change in the unexpected loss. So that is why we call it, it's not a linear function. I think that is the idea you need to get into your mind, because as a result of the increase of probability of default, it may not really affect the expected loss. Expected loss will have a very, very proportionate and minor type of increase. Whereas for a small change or small increase of probability of default will have an exponential increase in unexpected loss. So that is the issue. I think that you need to keep in your mind. That is why the banks and that type of organizations face severe consequences when an economic downturn is really experienced in the market. Now, in an economic downturn, most of the organizations will have an increase in their probability of default. Even though that increase is a fractional increase, it will affect the unexpected loss in an exponential manner. I think that idea you need to keep in your mind. Now I just put a graph on that. You can see the graph. It's a straight line for the expected loss. You can see EDF is the expected default frequency. That is in the horizontal axis. And when an EDF is going on, when EDF goes on, you can see expected loss also will go up. But it is in a gradual manner. You can see in a gradual manner it happens. But you can just look at the unexpected loss. Say, if the EDF is very, very much low, say it is very close to zero, there's a particular unexpected loss. But you can just see there's a small increase of EDF or the expected default frequency or the probability of default, then you can see the increase in unexpected loss. So that is we call it an exponential increase. I think you can have your mental picture on expected loss and unexpected loss through this graph. This is what you call the percentage loss per unit of AE. Percentage loss. So when you multiply it with AE is the average exposure or the exposure at default. So there you have the percentage loss per unit of AE. So that is what you can just think about. Now you see the unexpected loss curve. It's a very increasing type of a curve. You can see it goes up and up. Rather, you can compare it with expected loss. Expected loss is a straight line, which is, which makes an angle with the x-axis and it goes up like. But unexpected loss is a spontaneous type of graph. It is not a straight line, but it's a curve, upward type of a curve, highly upward curve. Now you just look at this slide where you can get a good idea. Now what I feel is now we might have to go through some calculations and the quantifications and all, but what I feel is you need to have a better understanding about these ideas, because it will help you to analyze the situation which you are going to face in the market. Therefore, these concepts are very important. Now I can repeat that concept. The unexpected loss, unlike the expected loss, will have an exponential increase with a fractional increase of probability of default. Now that is why now I can just give a very practical situation where a rating is downgraded certain company which you have lent. Now, for example, the company is a AAA one, but it has been downgraded to AA plus. That's only one notch downgrade. One notch downgrade. But when a one notch downgrade, it affects only a very fractional amount to the expected loss. But for unexpected loss, it will have a greater effect. So that is why you have to be careful. When one of your prime customers reported rating downgrade, that is the situation. Right. Anyway, now you can just look at this. Now in the left hand side, you have the increase in factor. The factors here, the considered factors are recovery rate, credit quality, expected default frequency. Now expected default frequency is very much closer to the probability of default. It's an approximation for probability of default. So therefore, we can see that probability of default also come in here in the place of expected default frequency. So you need to have that idea. But in practical terms, we call it expected default frequency because we are getting it from the data sometimes. That is why we put it as expected default frequency. So anyway, now you can see the factors. The factors are the recovery rate, credit quality, and the expected default frequency. Now you can see when it increases, the recovery rate increases, what will happen to the expected loss? It will decrease. Why? If the recovery rate is higher, you will get a better recovery and your loss will be lower. Therefore, expected loss will decrease with the increase of recovery rate. But when you talk in terms of unexpected loss, there also the same thing happens. Even the unexpected loss will go down with the increase in recovery rate. Now, increase in recovery rate means decrease in LGD, decrease in loss given default. So therefore, the less unexpected loss also will decrease. Now, when you talk in terms of the credit quality, now it's an overall idea. Credit quality, it depends on several things. One very basic thing it depends on is probability of default, and the other things are recovery rate and all those things come in under credit quality. But anyway, when credit quality increases, expected loss will decrease. Unexpected loss also will decrease. Now you just see the last one, expected default frequency. When it increases, expected loss increase, unexpected loss also will increase, but the increase is an exponential increase here. That is what you need to understand. So you can make a note there if you want. Even though here it is taken as increase, it is not a normal increase, it is an exponential increase. Now, the calculation of portfolio expected loss is given in a notation where it says ELP is the expected loss of a portfolio, and it is given as a sigma I ELI. That is, if you take any ith loan, that's a number. It can be 1, 2, 3, 4, 5, and so on and so forth. Then EL1 is the expected loss of loan number 1. EL2 is the expected loss of loan number 2. EL3 is the expected loss of loan number 3. Likewise, you can have all the expected losses of the portfolio. Now say if I is equal to 100, that means there are 100 loans in the portfolio. So then you will have 100 terms here. AE1 into LGD1 into EDF1 plus AE2 into LGD2 into EDF2 plus AE3 into LGD3 into EDF3. So likewise, you will have 100 terms, and all these 100 terms, the notation given here is the sigma. So that really denotes the summation. Summation of these things will give the expected loss of the portfolio. I think that is clear enough. And it's a simple thing. And when you do the current expected loss calculation as per the SLFRS 9 requirements, you will have to do this, because you are referring to the expected loss there in this audit practices and all. IFRS 9, you do the expected loss calculation. Now you go into a little composite type of a thing where you need to calculate the unexpected loss of an individual loan. So you look at the bottom part of this slide. There you have UL1 is equal to AE1 into the square root of EDF1 into sigma LGD1 squared plus LGD1 squared into sigma EDF1 squared. What is the meaning? What the meaning of sigma LGD is, what is the volatility of LGD? Because LGD is not a static term. Loss given default can change. Now, since it can be changed, it has a volatility factor. Sigma LGD is the expectation, or we call it the standard deviation of LGD. Sigma LGD is that. What is sigma EDF? That is the standard deviation of expected default frequency. Two standard deviation. Now it's a matter of calculating the standard deviation of LGD, and not only the LGD but the EDF also. Now you can see it is more complicated than calculating the expected loss. The calculation of unexpected loss is more difficult. It is a complicated type of function. Now you can just look at the notations here. AE1 stands for the adjusted exposure of asset A, asset 1. Then EDF1 is the expected default frequency of asset 1. LGD1, loss given default of asset 1. So these assets are taken individually. Right. Then now sigma, the denotation sigma is for the standard deviation, but when we say sigma LGD, the meaning is the volatility of LGD. When you say sigma EDF, that is the volatility of EDF. EDF is the expected default frequency. So that is how the things are denoted. So you can see the way unexpected loss is calculated. Unexpected loss is equal to AE1, that is the adjusted exposure of asset 1, into square root of EDF, that is the default frequency, into volatility of LGD plus LGD squared into volatility of EDF. Now you can see the way it is happening. When you talk in terms of EDF, you get the other one LGD and the sigma terms. And when you take the LGD in one side, the other side you get sigma EDF. I think that's an easy way of just memorizing these things. So that is the calculation of UL1. So that is the unexpected loss of a loan in a portfolio. But when you want to calculate the unexpected loss of the portfolio. Now, first of all, we assume there are only 2 loans in the portfolio. Now, in that case, there's a formula to calculate the unexpected loss of the portfolio with only two loans. It is given in the third or fourth line. There you say ULP is equal to the square root of UL1 squared plus UL2 squared plus 2 rho 1 2. Rho 1 2 is the correlation coefficient between loan 1 and loan 2. UL1 into UL2. That gives the portfolio unexpected loss. But here we assume there are only 2 assets in the portfolio. Now, rho 1 2 is the correlation between asset 1 and asset 2. Just look at it. Now you can see the rho will decide the portfolio unexpected loss. The rho can have a value from -1 to +1. That is the limitation of rho. Rho is the correlation coefficient. So it can take a value. The minimum it can take is -1, and the maximum value would be +1. It really lies between -1 and +1. Now just imagine a situation where rho is 0. Rho is 0 means in a very sound economic background, the loans may not have a default correlation because each loan has its own independent activity. So therefore, in a very sound economic situation, rho can be a 0. No relationship at all. Then the 2 rho 1 2 UL1 into UL2, that particular term doesn't come because it comes to 0. Then the answer would be ULP is equal to UL1 squared plus UL2 squared, the square root of that. So that is how you can get the portfolio unexpected loss. Now that portfolio unexpected loss can be higher when the rho is higher or the correlation is higher. When the correlation is lower, the unexpected loss of the portfolio is lower. That is how it goes. And this correlation can be minus also. If it is minus, then it is less than if it is minus, the particular loss, unexpected loss would be less than the loss where there's no correlation at all. So that is why in a type of a diversification, we need to put loans in one portfolio with different characteristics because it is a compensating type of an effect in the portfolio. Right. What I feel is now this particular thing you need to consider. What is this? And you might have a concern now. In practical terms, you cannot really have a portfolio with only 2 assets. No. At least there can be 100 assets in the portfolio. In a loan portfolio of a bank, you will see at least 100 assets. So in that case, how are we going to calculate this unexpected loss? What is the formula for that? So there's a formula. I'm not going to give it to you now, but there's a formula. And even that can be done through the computers without any issue. But we need to see, in order to calculate the portfolio unexpected loss. There you need to understand, or you need to find the correlation coefficient between each asset. Say, for example, if you have 4 assets, you might have, say, A, B, C, D. You need to check the correlation between A and B, B and C, C and D, A and C, and A and D. So all these things to be taken into consideration. So therefore, when you have 100 assets, there will be several correlations to be taken into consideration. So it is more than the number of loans. It is more than the number of loans. That is the issue. Now I will tell you there's a particular way of getting it. Now, in a practical scenario also, sometimes some banks they do it. I have seen in very internationally active banks like JP Morgan and Citibank and that type of banks. They do these things. The portfolio unexpected loss calculations and all, they do it through a computer. But the way it can be done is understood. And this formula is only for 2 assets, but when you have 3, 4 assets also, we can have this formula. And there's a matrix called variance covariance matrix, and with the matrix we can just calculate that. But I'm not going to just elaborate on those things, but what you need to understand is there are ways and means of doing these portfolio unexpected loss calculations. There's a possibility of doing it, and it is been done in the practical terms also. So therefore, don't think it as just a theory in a book. It is not the case. All the computer programs, I think some of your banks have these the computer systems, templates and all. There they follow this, and they have a methodology sometimes in the computer system. You will have to feed in the loans, the details of loans in the portfolio, and you might get the unexpected loss of a portfolio with some assumptions. So it can be done. It can be done. Right. With that, I don't know. I can just show you a way of, solving a problem or whatever. And this is another thing which you need to understand: diversifiable and under diversifiable risk in a loan, even in a portfolio context. If there are diversifiable risk, it is possible to reduce it to 0. Diversifiable means the firm specific type of risk. It really arising in the firm. But undiversifiable risk rising in the market. So those risks cannot be diversified, and we have to live with that. That is the issue. Now the concentration risk is a result of high correlations. Now you can just see the effect is the default on one asset spills over to other assets, exacerbating the problem. Now default correlation is our concern. The correlation of defaults, because that's a very, very dangerous and important type of factor we need to, since it is dangerous, we need to have a good idea about default correlations when you grant advances. Because I think what happens is in most institutions, people really, really misunderstood the function of credit risk management. They take it as just credit, granting credit or whatever, but it is not the case for risk management. So the risk managers will have to have a proactive idea about these default correlations, because then if they have that idea, they are in a position to avoid certain calamities. Now, dependence among defaults, I think there are certain limitations of this correlation factor. When defaults are not normally distributed, the zero correlation does not imply defaults are independent. So that is another factor we need to understand. So it's like this. Sometimes you feel that there's no correlation, but even though there's no correlation we can see, but there's a default correlation. So that is the issue. There's a function called copula we can make use of to evaluate the dependencies irrespective of restrictive assumptions. So, and which we call the Gaussian copula model. Now here there's a term called UI that is equal to AIF plus the square root of 1 minus AI squared ZI, where AI is the correlation between two assets. F is the common systematic risk factor. ZI is the idiosyncratic factor for ith asset. Now, I just told you in a loan or in an asset, there are two types of risk involved. One risk is the market risk or the systematic risk. The other risk is the idiosyncratic or inherent risk for individual, or what we call, sometimes we call it non-systematic risk. Now, the unexpected loss of a loan can be given in a relationship that is UI is equal to AIF and plus the square root of 1 minus AI squared ZI square root. So that is what you call the Gaussian copula model, where you get in a portfolio you get one asset and all assets are given in this particular format. In other words, you can say U1 is equal to A1F plus square root of 1 minus A1 squared Z1. Then second asset can be given as U2 is equal to A2F plus the square root of 1 minus A2 squared ZI. Likewise, you can put it. Right. Now, just, you should not get disheartened with all these formulas. Yeah, you should not worry about the formulas, but you should get the idea, the basic idea even from that. Now, during the presentation, I have given several basic ideas. One idea I gave was, in a portfolio, there can be a default correlation. There can be a default correlation which decides the unexpected loss of the portfolio. And not only that, you are in a position to calculate the unexpected loss of an individual loan, and the portfolio unexpected loss can be calculated with a formula with all the unexpected losses of individual loans calculated. But it is not the total of unexpected losses the portfolio loss comes. But unlike that, the expected loss, when you can calculate the expected loss of individual loans, you get the total of each loan. Expected loss of each loan will give the expected loss of the portfolio. That will be there. But unexpected loss, in terms of unexpected loss, it may not happen. So therefore, unexpected loss to be calculated by using a formula for the calculation of portfolio risk. Now I have given the formula for two assets or two loans. It is given as in the earlier slide. ULP, that is the portfolio unexpected loss, is equal to UL1 squared, that is the loan number 1's unexpected loss squared, plus loan number 2's unexpected loss squared, plus 2 into row 1, 2 is the correlation between loan number 1 and loan number 2 into unexpected loss of loan number 1 into unexpected loss of loan number 2. So this will give the portfolio unexpected loss. But it is in terms of only two assets. But in practical terms, you might not get a portfolio with two assets. At least you might have 100 assets in a portfolio. So therefore, you need to extend this formula for 100 assets. There's a formula for 100 assets. I can show it to you. For your knowledge, I will just give it. How are we going to do it with more than two assets? Even for n number of assets, you can do that. What happens is, you will get the first terms in squares, unexpected loss squared. Now, for example, say when you have 4 assets or say 3 assets, you will have to put UL1 squared plus UL2 squared plus UL3 squared plus 2 row 1 to UL1 UL2 plus 2 row 2 3 UL2 UL3, then plus 2 row 1 3 UL1 UL3. So that is the formula for the 3 assets portfolio to calculate the unexpected loss. Right. I think we can do some calculations and see how we can calculate the unexpected loss of a portfolio. I will put some sums on the board and just to give you a certain current type of ability to do this. Anyway, now these unexpected losses also can be calculated. Now, you just look at the board. Bank has a portfolio with 2 loans. Now, this is a very rare situation, but I just put it. The correlation between these 2 loans is 0.4. If the unexpected loss of loan number 1 and loan number 2 are rupees 2 million and rupees 4 million respectively, what is the portfolio unexpected loss? So you can do it with the use of the formula. So the formula is portfolio unexpected loss is equal to the square root of the number 1 loans unexpected loss squared plus number 2 loans unexpected loss squared plus 2 into the correlation into unexpected loss of 1 and unexpected loss of 2. So that if you do that and do the calculation, you will come up with the answer. So can you try to do that to get the unexpected loss calculated? Right, now it will give you a certain idea, but we will try to do it can you try to do it? This is a simple one, but you need to do it. Can anyone give the answer? Because the answer, if you get the answer, I want to just explain that and give some analytical points there.
So it's 1 million.
No, what you need to do is I have given the unexpected loss of each loan, number 1 and number 2. Unexpected loss of loan number 1 is 2 million and unexpected loss of loan number 2 is 4 million. And I have given the correlation also as 0.4. Now, what you need to do is you need to get the square of number 1 loan, that is 2 into 2 square of 2, that is 4, plus square of 4, that is 16. 16 plus 4 is 20. Then plus 2 into 0.4 into 2 into 4. That altogether that comes 26.4. And you need to get the square root of that. And that will come to 5 point something, but 26.4 square root 5.138. So the answer can be taken as 5.14. 5.14. I will put it on the board. Now this is the formula. ULP is equal to square root UL1 squared plus UL2 squared plus 2 rho 1 2 UL1 into UL2. So this is the formula. Now what we need to do is we need to apply the values here. Substitute the values. Square root 2 squared plus 4 squared plus 2 into 0.4 into 2 into 4. And this comes to square root of 4 plus 16 plus, this comes to 16 into 0.4, that is 6.4. And this comes to 26.4 squared. And it is equal to 5.138, so I can put it as 5.14. So ULP is equal to 5.14. 5.14. Now, what is the analytical point here? Now, if you take the two loans, two unexpected losses, one is 2, the other one is 4. If you just add it, you get 6. But now you see the unexpected loss total. As it is 6. But if you take the unexpected loss of the portfolio as in the formula, you get a value which is less than 6. It is only 5.13. 5.13. Now this value depends on the correlation. Now what you need to do is, now do it now. I will say the correlation has now come down to 0.1. 0.1. Now just calculate the portfolio risk. Now here I have given the correlation as 0.4, no? So you just get it as 0.1 and just calculate what is the, now I have calculated and told you the unexpected loss of the portfolio is 5.14. That 5.14 comes with what correlation? 0.4 correlation. Now you calculate it with the 0.1 correlation and see what is the unexpected loss of the portfolio. Just do it. Yes. Now only change comes with only change is instead of 0.4 for rho or the correlation coefficient, you just apply 0.1 and see the portfolio unexpected loss. Got the answer?
4.65.
4 point. You got the now it's like this, no? Now first two things will, there's no change in the first two things. That is 2 squared plus 4 squared. No, there's no change in that. Then you get 2 squared is 4, 4 squared is 60. 16 plus 4 is 20. Then plus 2 into 0.2 into 2 into 4. That comes as 16 into 0.2, that is 3.2. 3.2 plus 20, that is 23.2. You get the 23.2's square root. That is 4.816. The answer would be 4.82. 4.82. Now, what I want to emphasize is, now we took two situations. One, unexpected loss we calculated, the portfolio unexpected loss we calculated with rho is equal to 0.4. And when the second one we calculated when rho is equal to 0.1. I want to just emphasize the behavior of unexpected loss with the change in correlations. I will put it down. Rho ULP, unexpected loss of portfolio. When rho is 0.4, it is 5.14. When it is 0.1, it is 4.82. I just took it for the two decimals. Now just see. And you just do it for 0.05. 0.05. You will see a further reduction in the unexpected loss of the portfolio. Yes. Just do it with 0.05 correlation. 0.05 correlation. What is the unexpected loss? Yes. What is the unexpected loss of the portfolio? No other things changed, but only change we made was rho became 0.05. Rho became 0.05. Yeah.
4.48.
I think you do some mistake somewhere because the correct answer is 4.56. I will show you. Now, what you need to do is, the first thing, there's no change in the unexpected losses. So those are 2 and 4. So 2 squared is 4. 4 squared is 16. 4 plus 16 is 20. Then you get the other one, the third term, that is 2 into 0.05 into 2 into 4.
Right.
So then, what is that value? 2 into 0.05 into 2 into 4. That is 0.8, is it? That you got, no? 0.8.
Yeah.
0.8 plus 20.
Yeah.
That is 20.8. The square root of 20.8. That is 4.56. 4.56 is the answer. I think you can follow it. So then when the rho is 0.05, ULP is only 4.56. Now you can see the difference. When the row becoming lower and lower, the unexpected loss of the portfolio becoming lower. Now we can just do another experiment. Just see, when row is 0, what will happen? When row is 0, what will happen? When row is 0, what will happen?
Further go down.
Further go down, and what is the value?
Square root of 20.
Yeah, square root of 20 comes as 4.47. 4.47. And can you imagine something else also? Any more things can you imagine? Now row, can row be a minus figure? Row is the correlation, right? Correlation can vary between +1 and -1. If correlation becomes minus, what will happen? The portfolio loss further reduces. You can just check it and see. You can check. You can do an experiment and say when it is 0.1%, minus 0.11, minus 0.1, what will happen to the answer? Then you will get a lower, further lower, or even lower unexpected loss of the portfolio. So that means if you want to get the lowest portfolio unexpected loss, you can expect a minus correlation. Minus correlation. What is the minus? The least minus value for a correlation coefficient? -1. If you put -1 for the correlation, then you get the minimum portfolio loss. Now I want to just show you the portfolio loss clearly depends on correlation factor. If the correlation is very low, the loss becomes lower. But if you want to have a very minimum portfolio loss, you need to have a correlation which is minus. Right? But in most cases, in an economic downturn, we can't expect a minus correlation because the correlation will go very high in an economic downturn. Now, the correlation here means what? Default correlation. The correlation means, now when one loan defaults, what is the correlation or what is the relationship with the other loan to become default? That is what it means here. So therefore, if that default frequency or default correlation goes up, the portfolio loss also will go up. But in the case of default frequency, it is very, very rare. We record a minus correlation. Okay, but with that, I think you get some idea. Well, this is a practical thing. Now, say for example, you have a loan portfolio with several loans, and say for example, you have building materials merchant as one of your loan customer, one of your borrower. And sometimes you might have another customer, he is a construction company. Then you might have another borrower, he is a electrical items manufacturer. Now, likewise, you might have several industrialists and several sector people in your loan portfolio. Now say, In an economic downturn, the real estate and all sort of things will go down as nothing. So all these people will affect. Then what will happen? All the correlations will go up. But in a strong economic situation, this will not happen. Because there is no correlation as such. So that is the reason. Now, can you remember that I told you there was a Gaussian copula model where you just got some idea about FAI or something like that. I can go to that and show it. So that there are two factors. That market risk factor. I mean, when the correlation goes up, the idiosyncratic factor goes up. That is how it happens. Right. Now, shall we go into the presentation again? Right. Now, this is the formula we have used. But now you might wonder, in the practical situation where you might have 100 loans in a portfolio, how we are going to get the unexpected loss calculated of the portfolio? That's another issue. But I can just show you the formula for that. And it is not that difficult. So you might try it. I will put it on the board now. I can put 3 portfolio formula in the board, 4 loan portfolio in the board and all that. That I can do it. So anyway, so you can use it for any number of loans. And it can be worked out in an Excel sheet also, if you want. I don't know whether you used to do that type of things. Even I have seen in some banks, the employees, the credit department people, they have just constructed their own models in the bank through Excel. If you have an idea about Excel and if you have a good idea about the risk management also, then you can do that. I think that's a good thing for the bank. Right, anyway. Now you got my point where I told you the portfolio unexpected loss depends on the correlation. When the correlation is higher, the total loss of the portfolio is, unexpected loss of the portfolio is higher. When the correlation is lower, the unexpected loss of the portfolio is low. So that's an indication. So that is why in an economic downturn, the banks will have to face with severe unexpected losses. This is one of the reasons. Why? The correlations go up in an economic downturn. When the correlations go up, the portfolio losses will, unexpected losses will go up. And when the unexpected losses, you know, it is not only the rows effect, but there can be an effect of probability of default also. As I told you earlier, there's a fractional portfolio, fractional probability of default increase. There can be a very high increase in the unexpected loss. So likewise, you will see how the losses will increase of a credit portfolio in an economic downturn. Now I think you have enough reasons why to realize why it has happened like that. Because in this presentation, I just convey 2 things. One is the the increase of unexpected loss with the fractional increase of probability of default. That is one part. The other part is, in an economic downturn, the correlations will go up. With that, unexpected loss of the portfolio will go up. So these are the two basic factors where the loss, unexpected losses of portfolios, credit portfolios will go up. And you can just see the UL1 formula, that is calculation of an individual loan's unexpected loss formula. In that formula, you have three factors: LGD, EDF, and AE. Now, there also, when the EDF goes up, unexpected loss will go up in an exponential manner. Right. Now, anything you need to clarify on this? Now, I will go to the calculation of unexpected loss of an individual loan also here by using this formula. Yes. Now, I think that those concepts are very important for a portfolio level credit risk management. And I think for an institution, this is an important task, because in a credit committee level or risk management, credit risk management level, these are the more important type of things. Now, I think I will just put another one in order to calculate the unexpected loss of individual loan. Unexpected credit loss of individual loan. Now, this is really beyond the IFRS 9 things, because IFRS 9 things only limit to the expected credit loss. Here we are talking about unexpected credit loss also, because in order to provide for unexpected loss, then that is the real capital, and economic capital we call it. Banks are very much concerned whether they are in a position to provide economic capital. What do you mean by economic capital? Economic capital is the capital where you can absorb unexpected losses also. So if you can absorb unexpected losses, you don't have any worry, because even unexpectedly a big loss happens, there will be capital to absorb that. That is why we need to see how we can get at these unexpected loss calculations. Right. I will then go into the presentation again. Now, just make sure that you identify this particular formula, calculation of unexpected loss of individual loan in the portfolio. Right. We can do an example for that also. Right. Now there's a sum on the board. Right. Bank has granted an overdraft limit of rupees 100 million to a customer. When the utilized amount was rupees 60 million, the facility was defaulted. If the drawdown given default is 80%, drawdown given default is 80%, calculate the average exposure of the facility. That is the first part of it. The analysts found that the volatility of EDF and LGD as 0.2 and 0.4 respectively. EDF is taken as 10% and LGD is 70%. Calculate the unexpected loss of this facility. Now you can apply the formula and do the calculations. Now the formula can be taken from this. Now the formula is here. Now I will go into the code again. Right. I'll put the formula on the other side if you want. UL is equal to AE into the square root of EDF into sigma LGD square plus LGD into sigma EDF square. So this is the formula. Right. The formula is also given here. So you can just see how you can calculate it. So I think this is a direct application of the formula. And you only thing is you need to calculate the, you need to get at the AE, that is average exposure of this. With the data, you will be in a position to get it. Right, with that, I will just stop for the tea. You can have an interval about say 15 minutes. I will come back by 10:30. So while in the meantime, you can just go through this and have an idea. And we will discuss it after the interval. Come back to the session. Have you tried to do that? And first of all, you need to get the average exposure calculated. Now you just see the average exposure comes as out of 100 million, 60 million utilized. Anyone who got the average exposure calculated? Yes. Anyone who calculated the average exposure?
It's 92 million.
And
92 million.
60 plus, yeah, unutilized amount is 40 into 80%. That is, yes, 92, correct. 92 million is the average exposure. That is correct. Then you need to apply the formula for the others. So the formula is given on the board. Right. Have you done the final calculations? Now, first of all, you just try to get these things, values of these things. A is equal to 92. EDF is equal to 0.1 or 10%. That is 0.1. Then sigma LGD is equal to 0.4. Sigma LGD is equal to 0.4. LGD is equal to 0.7. That is 70%. And sigma EDF is equal to 0.2. 0.2. So that is those are the values you got. And anyone who got an answer for the unexpected loss? Now just try to put the values. Already calculated AE, that is AE is 92. Then EDF is 10%, that is 0.1. Oh. EDF is 0.10, then LGD is 0.7, sigma LGD is 0.4, sigma EDF is 0.2. These are the values which you need. But with that, anyone got your value? Please try that and get an idea about it. Now what you can do is you first you apply the values for the things which are in the square root mark, within the square root mark. Now just look at the formula. At AE you have to put 92 into the square root of EDF. EDF comes as 0.1. Then sigma squared LGD is 0.4 squared. So likewise you have to put the values there. So what is the unexpected loss of that loan? Just try to just get an idea. Yes. Right. Anyway, you just do it initially. The answer would be 17.36. 17.36 would be the answer. So that is the unexpected loss of this loan. The loan, no, this is an overdraft, and overdraft limit was 100 million, whereas the utilization, no, average exposure was 92, and out of this 92, the 17.35, that is the portion of unexpected loss. So that calculation we made. Now again we can go to the presentation. Now this Gaussian copula model, now here the unexpected loss is given by this relationship, where the F is common systematic factor and ZI is the idiosyncratic factor for ith asset. Right, now this is an important formula. So now the topic is analytic methods for credit portfolio risk assessment. Now, as we did last time, we did some probability of default calculations over Merton's model, where we could calculate probability of default. Not only the probability of default, we calculated the recovery rate, and even spreads also we calculated with that. And under the Vasicek model, this model really came into being in 1987. Very close, very recent past, the Vasicek model. In 1987, it was invented. Now, it really tries to derive a default PDF of a portfolio. PDF, what do you mean by a PDF? Probability density function. That is what you mean by a PDF. Correlation between assets and the expected default rate, EDR. Using estimates of these parameters, default rate may be computed. Now, this is the formula for the default rate to be calculated. But here there will be a certain limitation. Now, limitation is, now you have two things where PD is here and PD is here also. So you need not worry about it. Now it's like this. Now I want to show why this notation is made here. There's a thing called n minus 1 and n. Now when you say n, the meaning is you have to go to the normal curve table, standard normal curve table, and get the value. And that value is the n value for that. So that is the meaning of n. Then you might wonder, what do you mean by n minus 1? N minus 1 is the the reverse of that. Now, I can show you now, in order to look at something in the normal curve table. So then you need to say capital N. Capital N of something means you have to get the normal curve probabilities by looking at that number in the normal curve table. So I think you have a normal curve table with you. So I can just show you that. Right. Now you have this table. This is what you call the normal curve table. Now you can read the details given on the top. Value of nx for given values of x for a cumulative normal distribution with zero mean and unit variance. Now, when you say zero mean and unit variance of a normal distribution, such normal distributions are called standard normal distributions. Standard normal distributions. So, you need to get a schedule or chart with such values. And when you want to get n determined, so now when you say x here, the value is x. And if the x value is 2.5, then what you need to do is you need to go to this table and go for 2.5. .5 is somewhere here. Then the value for n 2.5 is 0.9938. So that is how the things been detailed here. Now I want to just explain what do you mean by n minus 1. Now you just look at the other one. Right. Here you have n minus 1. The meaning is you need to get the normal curve table and go into that value and see what are the x values for that. You have to do the reverse. When you see this type of a notation, you need to do the reverse of it. Right. I will just do a particular one and just show you what it is. Now, this is the probability of default of a portfolio where each loan's expected default rate is known. And not only that, we should know the cumulative probability function of probability of default of the portfolio. Cumulative probability function we call it. That is given in psi PD. But I think with that, I don't think that you get a proper understanding of these things, and since the symbols are really complicated. But anyway, I will show you how we can work out a particular problem with the use of this formula, and this formula is known as Vasicek model. Vasicek model, and here rho is the correlation between the loans in the portfolio. And we call it the correlation factor. Default correlation factor, we call it rho. Now you can just go through these things and see what are these notations explain. where rho is the asset correlation parameter. Psi PD. Now this letter is just like a three-shoulder. You can see it is called psi. Psi PD is the cumulative probability function for EDR. And N and N minus are defined where ND is the cumulative probability distribution for a standard normal variable with mean 0 and standard deviation 1. And N minus 1D as the random variable relevant to the area covered under cumulative probability distribution. So these are the explanations with regard to the notations given in the formula. Right. Now I will show you how we can get at this value. To see how this works, assume that rho is set at 15%. Rho is set at 15% and the PD of the portfolio is also 15%. If psi D is equal to 10%, psi PD is equal to 10%, the value of PD is then 4.82%. Now that is given and we can check whether it is correct. Now what happened was, now we have used these values and those values being substituted in the formula, and we will see whether the value gives the correct answer. Right. Now when you say to see how this works, assume that rho is set at 15% and the PD of the portfolio is also 15%. Now here what we can do is, now we have to see the portfolio PD. So that is in the left hand side PD. In the right hand side there are several notations, and those notations we have to identify as in this form. So I will put it on the board. Right. Now see this on the board. PD is equal to N n minus 1 EDR plus rho n minus 1 psi PD divided by square root of 1 minus rho. Now, you need to understand what it is. That is the only thing. So we will see now how we can work out the PD for the portfolio by using this formula. This same formula is on the board. Right. Now, rho is set at 15%. So the value of rho is 15%. And the PD of the portfolio is also 15%. PD means EDR here. And psi PD is equal to 10%. Now what we can do is we have to substitute these values in the formula. These values in the formula. Now when I say rho is 15% means it is 0.15. 0.15. Then here we have to get the square root of rho. So therefore we put it as square root of 0.15. Then n minus 1 psi PD. Psi PD is the probability distribution of PD, that is 10%, and that is 0.10. Then it is divided by square root of 1 minus rho. 1 minus rho is 1 minus 0.15. The square root. Square root of 1 minus 0.15. Right. So we will calculate it. And in order to calculate the denominator is 1 minus 0.15 square root. So 1 minus 0.15 will come as 0.85. We have to get the 0.85 square root. That is 0.92195. So you can put it as 0.9219 or 0.9220. We can put it as 0.9220. I think that is understood, no? So what we can do is you get the value as 0.92195. So since it is 195, so put it as 0.9220. And now we have to do another exercise where what is this value? N to the power minus 1.15. So that is the reverse of this normal curve values. So what we need to do now is we need to get this 0.15 and we have to see where it is located in the normal curve table. Where it is located in the normal curve table. So we can just look at it that way. The table right. This is the one. In the table. Now we are going to have this 0.15 located at the normal curve table. I think be careful when you have it. Right. Now I will show you how to get this n to the power minus 1 0.15 calculated. So the meaning of n to the power minus 1 is, what is the meaning? N to the power minus 1 is, you have to check 0.15 in the normal curve table and see what are the values of x for that. So then now we have to look at it in the table. 0.15 is the is that what you need? But unfortunately, you can't find 0.15 exactly here. But you can get a value which is close to that. It is close to that. Now you have 0.1515 and 0.1492. It is in between that. It is in between that. So therefore, so when the answer is given, the n to the power minus 0.15 would be, so you can just look at, this is the value you need now. This is the very close value. But there's a 0.0008 gap here, because what we need is not 0.1492, we know we need 0.1500. So therefore there's a 0.0008 difference here. So we have to account for that difference also. So therefore our value would be, you just look at the corresponding figure in this column, that is minus 1.0. But since the value comes here, what is this column number? That column number is 4, but it represents 0.0003. 0.0003. So therefore, the value can be minus 1.03, but it is not the very correct value, because what we need to look at is 0.1500, whereas we found only 0.1492, which is 0.0008 has a difference of 0.0008. So then the other closest one would be 0.1515. So then you can see what is the gap between these two. Gap between these two would be 23. So 23 is with the 0.01 gap, because this is 0.02, this is 0.03. Then 0.01 gap is with 23 points. But we need to just look at 8 points here. So therefore, it is less 8 points to this side. So that means 8 over 23 that is 0.34 of 0.01. Zero, zero, 3, 4, 0, 0, 3. Then we can say the value would be 0.01 minus 1.0 it is 4. The column is 4. Minus 1.0 which is just 0.01 little less than this. That means 0.003. 0.37, like 1.37, sorry. Oh. Zero 0.27 minus 1.027. So we'll check that. Minus 1.036. Then you need to calculate the square root of 0.15. That comes as 0.387. Then n minus 1 of 0.10. Again, we need to do that type of exercise where you have to go to the normal curve table and just check where this 0.10 located. Again, now just look at it and see, you all can understand what it is. Right. There you have to see where is 0.10. Now here you have 0.1190, but you have to get 0.10. But you have 0.1003 and we have 0.0985. I think this is in between this. So the value would be minus 1.2. Read this column. 28. 28. Yeah. Eight. $1.283. So then this has to be worked out and see the value. So when you work out the PD value, that is that we found minus 1.036 plus 0.387 into minus 1.283 divided by 0.9220. So that value, we can just show you that value comes as minus 1.66. Minus 1.66. So N. Now what you can do is, again, we have to look at this value in the normal curve table. But this is not the earlier way what we did. This is a direct look at the normal curve table. So you have to look at minus 1.66 in the normal curve table. So again, I will show you that minus 1.66. So minus 1.66 comes somewhere here. 66. Here is 0.0485. So that is the answer for the question. So that is 4.85. Right. You get the value 4.85. But as it is in the book, it says it is 4.82, but there are some rounding off error. That is why there's a small difference here. Rather than 4.82, we got 4.85 here. Yes, then we can go to the next slide. Now we are going to a very important point where we try to arrive at the worst case default rate of a portfolio. Now why we are going for this type of a default rate? Because in an economic downturn, there can be a default rate which would be a very high one, but that's a worst case. Worst case is that is the worst thing which would happen. And if you can prepare for the worst case, then you are okay with your risk management. That is why in the risk management, this particular concept is there. And not only that, there's a concept called value at risk. A value at risk is a particular concept where you have a very high confidence that you will not get a loss higher than that. So that is the concept of VAR. Now in this case, we can arrive at the credit value at risk by doing this calculation. Now credit value at risk means the highest risk or highest loss of a credit portfolio at a certain confidence level for a given horizon. Now in this case, we can calculate the worst case default rate of a portfolio. And the definition is now WCDR stands for worst case default rate. And you can see within the brackets capital T and capital X. Capital T is the time period or length of time. And X is the confidence level. What do you mean by confidence level? Confidence level is the confidence amount, or you are sure of that. You are sure that you are 99% sure that your loss may not be higher than that amount. So that amount is called the value at risk. So this concept is really taken into consideration here. So then this particular formula gives the way in which you can get the worst case default rate of the portfolio. Now, worst case default rate is taken on the basis of time period and a confidence level. Now, time period is T here, confidence level is X. And this EDR is the portfolio's expected default rate of each loan. And rho is the default correlation of each loan. And X is the cumulative probability function. Now I am referring to the WCDR TX. That is the in a portfolio worst case default rate. Now here you can just look at the expression P. Now what is this? WCDRTX into EAD into LGAD. Now for an individual loan, if you look at it, if EAD is the exposure at default and LGD is the loss given default, the X percentile of the loss distribution. So now this is the worst case default rate of the loan. And when you multiply these things, you get the worst case loss of the loan. Worst case loss of the loan, you can calculate by doing this. But we have a large portfolio of N loans. Each loan is a small part of the total portfolio. Then we can have this WCR or worst case default rate loss as the summation of all these things. These are the expected losses. Now we try to see the credit value at risk. Now the value at risk means, I don't know whether you followed market risk course where you just went through the market risk, value at risk, or value at risk in the market portfolios or whatever. But here we are trying to get the credit value at risk. So the concept of value at risk really explains the highest loss you expect at a certain confidence level. So the meaning is you are 99.9% sure that your loss may not go beyond that. But there's a small chance, 0.1% chance to have a loss which is higher than that. So that is the concept. That is the concept. Right, I will go to the text here rather than going to the presentation. I will go to the document, Word document. Right, in this Word document, right, I will go to this example directly. Otherwise, I don't think that you might get a good understanding here. So, in just demonstrating the solving of example, you might get the idea. Suppose that a bank has a total of $10 million of small exposures of a certain type. So 10 million is the total exposure. It contains several loans. The 1 year probability of default is 1%, and the recovery rate averages 40%. When you say recovery rate averages 40%, what is the LGD? 60%. Estimate the 99.5% 1 year credit value at risk using Masisek's model if the copula correlation parameter is 0.2. Now, here, what we can do is, we can just check what the question is given. Suppose that a bank has a total of 10 million. That is the total portfolio value. Or in other words, that is the exposure at default. Portfolio value. The 1 year probability of default is given as 1%, and the recovery rate averages 40%. Estimate the 99.5% 1 year credit value at risk using Masisek's model if the copula correlation parameter is 0.2. Now, here the correlation parameter is also given, that is rho. And I will show you how to estimate the things. First of all, you have to calculate the worst case default rate for a 99.5% confidence level for 1 year. Or we call it 1 year worst case default rate at a 99.5% confidence level. So that we can denote in this way: WCDR within brackets 1, 0.995. So that is the way it can be denoted. Now you just look at this formula. Here. Now, as per our example, what we put here, T is the time, X is the confidence level. So T is given as 1, X is given as 99.5. So 99.5 is given as 0.995. No? Yes, here they just gave it 99.5, that taken as now. Rather than giving it as a percentage, you can put it in decimal form, 0.995. 0.995. So that is the way it can be denoted. So it can be denoted in this manner. And then we can make use of the formula. The formula is this: n minus 1. What is EDR? EDR is the individual loans default probability. It is given. The 1 year probability of default is 1%. So then, what is EDR? 0.01 is the EDR. So then, what we can do is, we can put 0.0 n minus 0.01 here. Then square root of rho, that is the correlation coefficient. So correlation coefficient is also given here. What is that value? It is 0.2. 0.2 is the correlation parameter. So that also we can put into the formula. (0.2) square root n to the power minus 1. The x is the confidence level, that is 0.995. You have to put 0.995 here. Then divided by square root of 1 minus 0.2. That is the square root of 0.8. So then when you work it out, you get a value within the brackets. You have to get the normal curve area of that value. So that is how you can solve this question. Right. Now I will put it on the board. Right. The question is this. It is given in the document. Suppose that a bank has a total of $10 million of small exposures of a certain type. Now there can be number of exposures, small exposures, total into 10 million, total into $10 million. The 1 year probability of default is 1% and the recovery rate average is 40%. Estimate the 99.5% 1 year credit value at risk using X model if the popular correlation parameter is 0.2. Right. So I want to just demonstrate the solution of this example. So we have to use the X model, and then there you have the left hand side as WCDR TX. WCDR is the worst case default rate, and TX is T stands for the time period, X stands for the confidence level. So X stands for 0.995 in this question. So I will put it on the board, right? Anyway, you also can try that. Now what you need to do is you need to write on piece of paper this particular formula. This one is the formula, and just substitute in the values to this formula. Because EDR is given, rho is given, and X is given. P is also given, so therefore you are in a position to get these things calculated. Okay. Anyway, I don't know. What is your response? I feel that it's little difficult for you to just follow? I don't know. What do you think? Yes. You have to give your responses because this is a little complicated type of a thing where you are not very familiar with the denotions and all, the codes, denotes and all. It's a little difficult task for us. But what we need to do is we need to see how we can make use of these things in our practical situations. And in your most of your computer systems, these things are included. But if you don't have a basic idea about these things, it is little difficult for you to apply the things with a certain understanding and awareness. So there is a necessity here. Anyway, you need to interact. What do you say? I mean, I'm just trying to demonstrate it. Yes. Now, the last thing which we discussed as the example, there we need to get the credit value at risk of a particular portfolio. So that portfolio is 10 million. The total portfolio value is $10 million, and LGD is given. Then you need to have the credit value at risk calculated for a horizon of 1 year and a confidence level of 99.5%. So that I will put on the board. This is how the formula is given. WCDR TX is equal to N minus 1 EDR plus rho into N minus 1 X divided by square root of 1 minus 4. Now this is the formula. This is the formula for the worst case default rate. Now what we do is, we will apply the values given in the example here. Now the values given in the example means, now they need to get the credit value at risk, and their period, the time period is 1 year, and confidence level is 99.5. So therefore we can put here WCDR 1,995 equals N minus EDR. EDR is how much? As per the example, you can go back to the example and see what it is. Yeah, the 1 year probability of default is 1%. 1%. And the correlation parameter is 0.2. So what we can do is, we can just go into the again. We can put the values. EDR is 1%, that is 0.01. plus rho is 0.2 n to the power minus 1, x is 0.995 divided by square root of 1 minus 0.2. So this is the way the formula is used. Formula can be used in this manner. If we can do the simplification, n minus 1.01 and 0.2 into n minus 1.995 divided by, now 1 minus 0.2 is 0.8, square root of 0.8. Right. Now you will try to get the values of n minus 1.01. Now in order to get the value, you have to go to the normal curve table. Here also you need to get, so as an exercise, can you do that? The tables are available and you look at the table and see what is the value here. 0.01. This is the reverse. This is the reverse of that. Here also the reverse, 0.995. Can anyone try? Yes. Now in this case, we have to look at 0.01 in the normal curve table and locate it, because it's a reverse process. It's a reverse process. That is why we put -1 here. It's a reverse process. Here also the reverse process. The meaning of reverse process is, why what we need to do is we need to just look at the normal curve table and find out the location of it. So that is what we have to do here. But after getting all these things solved, we have to get the normal curve values again. Right. Now, as the first step, we will try to see this n minus 1.01. Are you just following? I'm really talking to a silent audience. Yes.
Sir?
Yeah.
So there's a, like in the tute, you have mentioned a square root in the formula that you have not mentioned in the whiteboard there. There's a n minus n minus 1 EDR plus square root of rho n minus 1 x.
It is not square root. Square root, it doesn't come. Square root doesn't come there. It is just row.
Ah,
yeah.
Okay, sir. Okay.
In the formula also it is not the case, but square root comes only in the denominator, right?
Okay.
In the denominator only square root comes. Here it doesn't come.
Okay.
Just row, right? So now you try to get this n to the power minus 1.01. That is the reverse of this. So what you have to do is you have to look at the normal curve table and locate it. It's 0.01.
Okay.
Shall we try to do it?
Yeah. Yes.
Right. So just look at, I think you have with you the normal curve tables, no? Tables are with you?
Yes, sir.
Right, right. You can just look at, anyway, I will put it on the screen if you want, right? Do you need to have that on the screen? Or you have it with you? Right, you look at the normal curve table. Now, in order to get this n minus 1.01 calculated, what we need to do is you need to locate 0.01 here, right? So just see how we can locate it. 0.0100. See, that is what we need to look. We will see where it comes. 0.01. 94, 96, 99. Is it clear now? You don't, unfortunately, you don't get 0.0100 here, whereas you get 0.0102 and 0.0099. What is the most closed one? This is the most closed one, no? So we are looking for 0.0100, whereas we get in the normal curve table 0.0099. Even though it is very close, but there's a small difference here. How much? 0.0001. That's the difference. But when you look at the next closest one, that is 0.0102, and just look at the two values. Here you get 0.0102. Here you get 0.0099. What is the range, or what is the difference between these two? 0.0003, is it? You get my point. So that 0.003 is the range between the second and the third columns, right? So that 3 is distributed with 0.01 range. So then we can see what is the value pertaining to 0.001. Here the 1 is divided between 0.01 is divided between 3. 0.0003. So that means one third means you can say it is 0.2 here minus 2.3. It is not 2. It is not 3 even. It is in between this. In between, but it is more close to this. More close to this. So your range has to be divided into, 2/3 comes here, 1/3 goes there. So 1/3 is 0.3003. That means you can say 2.33 not 3. 2.8 line. 2 minus 2.338 like 338 or 337 like minus 2.337 337. So that means it looks like 34 not 34. Sorry, it's 2.327 like 2.327 like 27 or 28 like. I don't know whether you are getting my points, because what we need is we need to check 0.01 on the normal curve table. Now you look at the table. Unfortunately, you are not getting the exact 0.0100 here. Whereas you get close type of things. There are two close items here. 0.0099 is there. All of you will agree that is the closest one. But there's another one. Earlier one is only 0.0102. Now you will see when the things are going up, the values go down. So therefore, you can't say it is minus 2.33. It is wrong. It is less than that or higher than that. That is what you need to understand. It should be less than that because the 100 can be, or 0.0100 can be little before that. So therefore, it should be minus 2.32, minus 2.32. The last point should be either 7 or 8. We can say 7. So then n to the power minus 0.01 is taken as minus 2.327. Minus 2.327. 327. Then plus 0.2 into n to the power minus 1.995. Our second task is to get the n to the power minus 1.995. Now, are you comfortable with getting these reverses in the normal curve table? Reverse things in the normal curve table? Are you okay with that? Are you okay with getting these reverse things in the normal curve table? Now, we have another one to look at that way. 0.995, you have to look at the normal curve table and location. Is that okay? Now, have you followed this this particular number? You are okay with the finding of this one? That is n minus 1.01. That is the reverse normal curve score of 0.01. Is this? You know how we got it? Right. Anyway, I will go to the next one also. There, what we have to do is, we have to get the 0.995 located in the normal curve table. Located means we have to get the location there and we have to get those numbers. So we will see that. Right. 0.995. Just look at it. You have to locate 0.995 on the normal curve table. 0.995 is 99. You need to go further down. 951, 968. 99. Where is 99? It may be somewhere on the other side. Here 0.9950. 9959 is there. 553 there. Now 52515. Here you have 9951 here, not 9950. But unfortunately our value is 0.9950, whereas you get only 0.9951. But there's another one, 0.9949 also. Now, when you say from 0.9951, that is higher than 0.9950. If you take 0.9949, it is lower than 0.9950. Then you have to locate it in between that. So, in the middle line, so you can say, now if you just look at it, 7, right? So 2.57, this is 2.57, whereas the real value would be 2.575 because it is in the middle line. 49 and 51, the difference is 2. So you have to have 1. 49 plus 1 would be 50, no? So therefore, it is in the middle. In the middle means between 7 and 8. So therefore, you can say 2.575. 2.575 will be the answer for that. So then we will put 2.575 there. And the denominator, it's a matter of calculating the square root of 0.8. That is 0.8944. Right. I will just put you onto the board again. Right. The values are here. Now, what we can do is we can simplify the numerator. By simplifying the numerator, you might get 0.2 into 2.575 minus 2.327. You might get to the numerator minus 1.812. Minus 1.812 for the numerator, right? It's to be divided by 0.8944. So what is that? The value is I don't know. Now we can further simplify that by dividing it with 0.8944. There you get minus 2.0259. $2.0259. Now that is n minus. So how are we going to deal with that? Now you can go to direct to the normal curve table, and this is not a location. You have to see the value there. Now just identify the difference between looking at n and looking at n minus 1. So that particular differentiation you need to understand, right? So the final value will be n minus 2.0259. Now, since we are not in a position to have 4 decimals in a normal curve table, we have only, when we look at the normal curve table values, it really limits to only 2 decimals. So therefore, you can take it as minus 2.03. Minus 2.03, you will take it as that. So when you take that way, I will show you the way it can be done in the normal curve table. Now you need to look at minus 2.03. 2.03. Yeah. So how are we going to do this? 2.03, so it's further down. Minus 2.03. Here is minus 2.003 would be somewhere here. Minus 0.212. Minus 0.212. Minus 0.212 is the value. Sorry, not minus. It is, the value is minus. Sorry, 0.021. 0.0212 is it? Yeah, 0.0212. That is equal to 2.12%. 2.12%. The value would be that the worst case probability of default of the portfolio comes as yes. Worst case default comes as how much? 2.12%. Now, what is your response here? Now you are comfortable with using the normal curve table? Yes, what you are going to say? Are you comfortable with using the normal curve table? Because that is the most important thing here, because you are not in a position to do anything without that. So now I will go to the text now. Now in this text, I worked it out. There you get a separate answer. But I think in this particular text, the formula is little wrong, I think. Anyway, that I made a mistake there, I think. It's not a square root there. It's just 0.2. Actually, now I made a mistake there actually. So the square root mark is there. I think one person really told me, Anyway, the square root mark is there. Square root mark is there. Are you with me now? Actually, I really made a mistake earlier. As that particular student told me, there should be a square root mark here. I just mistakenly I told you that it was not there, but it should be there, right? You got my point? Hello. So I really made a mistake earlier.
Yes, sir.
Right. It is there, right? You are correct, huh? It is
Okay.
there. It is there.
Okay, sir.
Right. So now we have done the particular calculations, and the denominator is 0.8944, and numerator you have to get that is you just do it with the numerator 0.2 squared into 2.575. Minus 2.327. Now you get a value on as the numerator, it is minus 1.175. Minus 1.175. And it is to be divided by 0.8944. .8944. Now we get minus 1.313. So we can say n minus 1.313. And it is really, you go to the two decimals, and that should be 1.31. 1.31. Then now we can just go to the normal curve table and see that right. Now in the normal curve table, we have to look at 1.31. So how are we going to get it? It is minus, right? Minus 1.31. That correct? Square root of 0.2 into 2.57. Right. Now, in that case, you need to get, you might have this particular number, minus 1.31 is here, is 9.51. Anyway. Is it okay? Right. Now we will go to the real part of it. Now in the real part, when you go there, so we can, in the example, there's a small mistake here, 1.36, it came as 1.36, 37, 827. Right, anyway, the numbers may have some small differences. Then our calculation should be 1 year WCDR of the portfolio at 99.5% confidence level. That is the form. This is the value as it is. But for our calculation, I think there's a small problem here. Please, I think I just put it as 2.37, whereas it should be 2.327. Okay. Right. Now, just go into the next part of it. There, the value is this, as per these numbers, 8.66, and 1 year rate value at risk of the portfolio would be, you have to apply this portfolio worst case default rate, and it has to multiply it with LGD. Now, recovery rate is here given, it is 40%, and since recovery rate is 40%, the LGD would be 60%, and the value of the portfolio is 10. So you get this value as the credit value at risk. But I think there's a small mistake here. Anyway, those are calculation mistakes. This 2.37, it should be 2.327 or something like that. Anyway, right. Now, what I want you to ask is, are you now familiar with looking at this normal curve tables? No, that is the most important in here. Otherwise, you might get wrong. And as it is the formula, but don't worry about the formula because it is given. Even in an examination, these formulas will be given. But you need to understand the notations. That is the only thing what I want to tell you here. The notation should be understood. Right. So that's what we did there. And we really went on trying to have this worst case default rate calculated. And I want to just put you into another fundamental principle. So that is now just look at it. Now in the presentation, I just put those things also. Now this is the credit value at risk. Actually, here we did the same thing. Now there's a small adjustment here. If the horizon is more than 1 year, then there will be a maturity adjustment also. Now I want to just tell you another principle here. There's a concept called economic capital. Now, what do you mean by economic capital? Normally, we keep capital to cover the loss, expected loss. But in terms of Basel principles, banks will have to maintain capital to cover unexpected loss also. If you try to realize or try to calculate the worst case loss and provide capital for that, the meaning is you are highly covered of unexpected losses also. So therefore, you are at a highly efficient risk management framework. So therefore, even without the regulatory implications, the banks try to do that. So in order to do that, they need to calculate the economic capital. So how do they calculate economic capital? They will try to see what is the unexpected loss of a certain portfolio, and they provide capital for that unexpected loss. If they provide capital for unexpected loss, we call it the economic capital. So sometimes a particular problem might come to ask you what is the economic capital of certain things. So then that means you have to go into the value at risk and calculate the value at risk, and that value at risk amount would be the unexpected loss or economic capital. And there's another important thing here. Now, when Masisek model is used to determine the economic capital, banks can have their own estimates for rho. Rho is the correlation, default correlation. Now, rho for two company loans should be approximately equal to the correlation between the returns of the assets of the companies. Or roughly this is the same as the correlation between the returns of their equities. Now, why we have this type of concept? The reason is it is easy for you to, as a bank, it is easy for you to get the details from stock exchange than anything else. So therefore, banks try to look at the correlation between two borrowers by going through their correlations of equities. That can be obtained from the stock market. So that is how this rho is calculated by the banks. But unfortunately, if the companies are not listed in a stock exchange, then you may not be in a position to get this data. So then what are we going to do? Then you have to have a methodology to map the companies and map in the sense you have to see the similar type of companies which have been already listed. You have to compare the probability of default and the correlations of those companies, and really see, you can consider it as similar for these unlisted companies also. So that's a type of estimation. So that is what we can do for a company which is not in the stock market or which is not listed in the stock market. Now, when worst case default rate for the portfolio is calculated, is assumed that the correlation between any pair of companies in the portfolio is a value in the range of 0.5 to 1. Higher the correlation, more severe the economic downturn. Or the other side also. More severe the economic downturn, higher the correlation. That also can be taken as correct. In normal economic conditions, PD of each loan is similar and it can be considered as the portfolio PD and the value is close to 0. Now I have just put the value calculation for portfolio expected loss. It can be done through the portfolio PD into portfolio EAD and portfolio LGD. So that will give you the portfolio expected loss. And unexpected loss, we need to get the worst case PD minus portfolio PD into portfolio EAD and portfolio LGD. That will give you the unexpected loss. Right. I think this particular thing, you need more analytical thoughts and more exercises. I think there's another exercise given in the text. So you try that exercise, because I have not given the answer for that. You try it. Next time you will be in a position to really get it. And what I suggest is, these are not only in the book. So you can make use of these things in your day-to-day activities. I don't know whether you are in a position to do that, but if you can get hold of some data, for example, say in your bank you have a rating model also, so you can get a portfolio where it is say a similar rating. So you have a say SMI or whatever loans portfolio, and those loans are in the same rating category. If the loans are in the same rating category, the meaning is their probability of default is more or less the same. And then what you need to do is you need to see what is the likely correlation of these companies. So you can give different values for correlation and see what would be the worst case loss. So such type of analysis you can do by using this Vasishek model and all. I think in trade portfolio risk management, now these things are very, very important. These are called structural models. So you need to have a good idea about these things. Any question? Any question of this, what we did today? And I think it's little cumbersome, some of the formulas, but even though it's cumbersome, you don't need to worry about the memorization or whatever, but you need to have idea, or you need to have familiarity and with the notations and the principles behind that. Yes. Any question or any clarification? Yes. No, what I feel is now, since this is an online thing and it is difficult for you to really concentrate on the things properly. What I feel is, I can see now when it started, there were about 11 or 12 people, but now it is only 7. So anyway, the meaning is it is little difficult for you to concentrate on the lesson by be there. So these are the types of issues in this online type of delivery. But anyway, I suggest that you try your best to go through these things again at your leisure. See how you can understand these things. And you need to check your understanding by applying the things into the day-to-day activities and your thinking. That is very important for your work. With that, I wind off the things if you don't have any other questions. Thank you very much for your live participation. And we will meet again on next week. And in the meantime, you can just see what are the types of issues you come across, and those issues can be sorted out at the next lecture. Right. Thank you very much.